Gold Rs 1.4L, silver Rs 2.9L. The truth behind today's crash. Union Budget 2026 impact, February 1st, 2026. Gold crashed Rs 13,468 in a single day. Silver collapsed Rs 45,000 per kilogram. Billions evaporated. Margin calls executed. Accounts wiped clean. But here's what the panic is hiding. Central banks bought 146 tons during this exact crash. The supply deficit in silver just widened further. And three forces are converging right now. Forces that will separate wealth preservation from complete capital destruction in the next 90 days. One analyst predicts R2,000 gold by December. Another warns of collapse to Rs 120,000. Both cannot be right, but one of them is about to be proven correct. And the window to position on the right side is closing faster than most realize. Welcome to AU and AG. If you have spent enough years in markets to understand that real wealth is not built on hope, but on data, on discipline, on the ability to see what others miss when chaos erupts, then you are in the right place. This is not a channel for speculation. This is a research station for serious capital. Consider subscribing, not because of yesterday's panic, but because of what the numbers are revealing about tomorrow. Think of it as keeping one reliable source in your analytical process, the kind that presents both sides of the equation before the market forces you to choose one. And take a moment to leave a comment below. Where in the world are you watching this analysis from? Lahore, Karachi, Dubai, Mumbai, London? Let us know. Because when markets move this violently, perspective from across continents and time zones becomes strategic intelligence. Now, let us examine exactly what these numbers mean and what they are not telling you. On the morning of February 1st, 2026, something happened that most investors were not prepared to understand. Across India, Pakistan, the Middle East, and beyond, traders opened their platforms, they checked their positions, and they saw numbers that told a story far more complex than the panic suggested. MCX gold futures are 140,000 per 10 grams. MCX silver futures are 291,922 per kilogram. For those who had been watching carefully, these were not just prices. These were coordinates on a map that showed exactly where serious money was positioned and where amateur capital had just been eliminated, because something remarkable had occurred in the previous 72 hours, something that separated those who understood market structure from those who simply followed momentum. Just 3 days earlier, on January 29th, gold had touched an all-time high in Indian markets, Rs 149,653 per 10 grams, a level never seen before. Silver had reached Rs 420,048 per kilogram, the highest point in over 4 decades. Social media erupted. YouTube channels declared victory, comment sections filled with celebrations. Predictions of Rs 5 lakh silver became common. Some even suggested Rs 6 lakh was inevitable. And then, Friday happened. January 30th, 2026. A single trading session that would separate preparation from speculation. Gold fell Rs 13,468 in one day. Nearly 9% erased in hours. Silver dropped Rs $45,000 per kilogram, over 11% gone before most traders could react. The violence was immediate. Leveraged positions were liquidated. Margin calls were executed automatically. Accounts that had been profitable just 48 hours earlier were now completely wiped out. Billions of rupees in paper wealth vanished. But here is the number that mattered more than any other. The number that professional risk managers were watching while retail traders panicked. Despite the worst single-day crash in recent memory, silver was still up over 30% for the month of January. Gold, despite its dramatic fall, was still up approximately 15% for the same period. This was not opinion. This was not analysis. This was simple mathematics. And mathematics does not respond to emotion. The question facing every serious investor on that Sunday morning was not whether the crash had happened. The crash was fact. It was documented. It was measured. The question was what these specific price levels revealed about the forces still operating beneath the surface. Because while retail investors sold in panic, while social media filled with accusations of manipulation, while trading forums erupted with anger and confusion, a different story was unfolding. A story visible only to those who understood the difference between paper markets and physical markets. The crash had been concentrated almost entirely in futures contracts, in leveraged positions, in speculative call options purchased by traders who believed the rally would never end, in derivative instruments that amplified both gains and losses. But the physical market, where central banks store their reserves, where pension funds allocate for decades, where sovereign wealth operates, that market remained remarkably stable. This divergence was telling a story about who was selling and who was buying, a story about the difference between speculation and strategic allocation, a story about what happens when leverage meets volatility in markets that billions of people depend on for wealth preservation. The trigger for the collapse was specific and identifiable. On Friday morning, January 30th, Donald Trump nominated Kevin Warsh as the next chair of the United States Federal Reserve. Kevin Warsh, a man whose entire monetary philosophy was formed during the 2008 financial crisis. A man who had argued, even during the depths of that crisis, that the Federal Reserve should not engage in aggressive money printing. A man who believed that protecting currency value required accepting short-term economic pain. His nomination was announced Friday morning. By Friday afternoon, gold had fallen hundreds of dollars globally. Silver had lost over 30%. The market was not reacting to what Warsh might do in the future. The market was reacting to what Warsh represented in the present, a potential return to monetary discipline, a Federal Reserve that would prioritize currency stability over asset price support, a central bank that might allow interest rates to remain elevated far longer than markets had priced in. But there was a second factor operating beneath the surface, a factor specific to Indian markets, a factor that would determine the direction of domestic prices in the hours ahead. Today, February 1st, 2026, was Union Budget Day. Finance Minister Nirmala Sitharaman was presenting Union Budget 2026, and market participants were watching for one specific detail that could move prices immediately: import duties on gold and silver. India is the world's second largest consumer of gold. Any change in import duties would have instant and material impact on domestic prices. Speculation had been building for weeks. Would the government raise duties to protect the trade deficit? Would they lower duties to support the jewelry industry? The uncertainty created a perfect storm when combined with the Federal Reserve news. MCX had opened a special trading session on Sunday specifically because of the budget. This was not normal market hours. This was an exceptional session for an exceptional day. And in that session, the full force of Friday's global crash combined with budget uncertainty created the violent price action that investors witnessed. The numbers on the screen that Sunday morning were not random. They were the mathematical result of three forces colliding simultaneously: global monetary policy shift, domestic budget uncertainty, overleveraged speculation meeting forced liquidation. But beneath the violence, beneath the panic, beneath the billions in liquidated positions, something else was happening, something that contradicted everything the headlines were screaming. There's a pattern that repeats itself in financial markets with mathematical precision. It is repeated in tulip bulbs in 1637, in railway stocks in 1847, in dot-com equities in 2000, in real estate in 2008, and it repeated again in precious metals. On January 30th, 2026, the pattern is simple. Prices rise, excitement builds, caution is abandoned, leverage multiplies, and then something breaks. That breaking point is never random. It is never mysterious. It is always preceded by warnings that professional traders see clearly and amateur speculators ignore completely. 3 weeks before the collapse, exchanges began sending signals that most retail investors never noticed. Margin requirements for silver contracts were raised. Not once, not twice, 3 times in 14 days. Each increase was small. 5% here, 7% there. Small enough that casual traders barely registered the change, but large enough that professional risk managers understood the message. The exchange was seeing positioning that concerned them. They were seeing leverage levels that posed systemic risk. They were seeing too many traders controlling too much metal with too little capital. When exchanges raise margin requirements, they are not making administrative adjustments. They are attempting to prevent catastrophe. They are forcing overleveraged traders to either add more capital or reduce their positions. But for traders already stretched to maximum capacity, a margin increase is not a warning. It is a countdown timer to forced liquidation. The second signal came from technical indicators that experienced traders monitor obsessively. The relative strength index for both gold and silver had entered territory that technical analysts classify as extreme danger. Gold's RSI had touched 82. Silver's RSI had exceeded 90. For those unfamiliar with this metric, understand what these numbers represent. An RSI above 70 is generally considered overbought. It suggests that an asset has risen too far, too fast. It suggests that a correction is likely. An RSI above 80 signals that correction is not just likely, it is imminent. An RSI above 90 is rare. When it occurs, the subsequent reversal is almost always violent, almost always devastating to those positioned on the wrong side. But on social media platforms and YouTube comment sections and trading forums across the internet, these warnings were invisible, drowned out by a different narrative. Silver to Rs5 lakh, gold to Rs2 lakh. The rally will never end. This time is different. The exact phrases that appear at every market top throughout history. And then Friday morning arrived. The announcement came through official channels at 9:47 a.m. Eastern Time, United States. President Donald Trump had nominated Kevin Warsh as the next chairman of the Federal Reserve. To understand why the single announcement triggered a global cascade, one must understand who Kevin Warsh is and what his nomination represented. Warsh had served on the Federal Reserve Board of Governors from 2006 to 2011. He had witnessed the 2008 financial crisis from inside the institution, responsible for responding to it. And his response to that crisis revealed his entire monetary philosophy. While other Federal Reserve officials pushed for aggressive intervention, for unlimited money printing, for zero interest rates and massive bond purchases, Warsh had argued for restraint. He had written that the Federal Reserve's primary responsibility was maintaining currency integrity, not supporting asset prices, not rescuing speculative positions, not ensuring that markets never declined. His writings during and after 2008 made his position clear. Short-term pain was acceptable. Market corrections were necessary. Protecting the value of the dollar required discipline that might be politically unpopular, but economically essential. And now, this man, with this philosophy, had been nominated to lead the world's most powerful central bank. The market reaction was instantaneous. Gold futures in New York dropped $127 per ounce in the first hour after the announcement. Silver fell $3.84 per ounce, a 14% decline in 60 minutes. The sell-off spread across time zones. London markets opened lower. Asian markets followed. By the time Indian markets processed the news, the global cascade was already underway. But the violence in Indian markets was amplified by a factor unique to this specific day. Union Budget 2026 was scheduled for February 1st, and with it came uncertainty about import duties on precious metals. India imports over 800 tons of gold annually. The country is the second largest consumer in the world. Import duties directly affect the premium that Indian gold prices carry over international spot prices. For weeks, analysts had speculated. Some expected the government to raise duties to curb imports and protect the widening trade deficit. Others predicted a reduction to support the jewelry industry and boost domestic consumption. The speculation created positioning in MCX futures. Traders built large, directional bets based on which scenario they believed would unfold. Long positions betting on duty reductions, short positions betting on increases. This created a market structure that was fragile, overleveraged, vulnerable to any unexpected shock. When the Kevin Warsh announcement hit global markets on Friday, that fragility was exposed brutally. MCX had scheduled a special Sunday trading session specifically for Union Budget Day. This was unusual. Sunday trading is rare, reserved for exceptional circumstances. And when that session opened on February 1st at 9 a.m., three forces collided simultaneously. Global weakness from the Federal Reserve news, domestic uncertainty about budget policy, and overleveraged speculation that had ignored every warning signal in the preceding weeks. The result was mathematical, inevitable, brutal. Traders who had used maximum leverage saw their positions liquidated automatically. The exchange's risk management systems did not wait for consent. They did not provide warnings. They simply closed positions to protect the integrity of the market. Those who had allocated reasonable portions of their portfolio to precious metals, who had maintained appropriate position sizes, who had not gambled with leverage, they experienced pain, but they survived. Those who had bet everything on continued upward momentum, who had ignored margin increases, who had dismissed overbought technical readings, they experienced something different, complete capital destruction. By Sunday afternoon, the damage was quantified. Gold had fallen from Rs 149,653 to Rs 140,000. Silver from Rs 420,48 to Rs 291,922. The headlines screamed manipulation. Social media erupted with conspiracy theories. Trading forums filled with anger. But the data told a different story. A story about warnings that were visible, signals that were clear, risk that was quantifiable. The only question was whether anyone had been watching. There's a difference between price and value that most market participants never learn. Price is what appears on a screen. It fluctuates minute by minute. It responds to emotion, to headlines, to speculation. It can be manipulated in the short term by large players with deep pockets and strategic intent. Value is something else entirely. Value is determined by supply and demand at the physical level, by geological scarcity, by industrial necessity, by central bank strategy that operates on decade-long timelines rather than daily price movements. And on February 1st, 2026, while speculators panicked over price, institutions quietly evaluated value. Because something remarkable was happening beneath the surface chaos, something that contradicted every headline screaming about collapse and catastrophe. While retail traders were selling in panic, while margin calls forced liquidations, while social media declared the precious metals rally dead, central banks across the world continued doing what they had been doing for 27 consecutive months. They bought gold. Not small amounts, not symbolic purchases, real material accumulation. Between January 1st and January 31st, 2026, global central banks purchased an estimated 146 tons of gold. This was not speculation. This was documented through official reserve reporting, import data, and verified transactions. 146 tons in a single month. during the exact period when retail speculators were buying call options and leveraging their accounts to maximum capacity. The People's Bank of China had added to its reserves for the 27th consecutive month. Not 26, not 25. 27 months without interruption. This was not trading. This was strategic policy execution. China was not buying gold because of a YouTube video predicting RS5 lakh silver. China was buying gold because of a calculated assessment of global monetary architecture. Because of a long-term strategy to reduce dependence on the US dollar in international trade and reserve holdings. When the crash happened on January 30th, when prices fell violently, when panic gripped markets, did China's central bank reverse course? The data suggested otherwise. If anything, lower prices represented opportunity for continued accumulation at better entry points. India's Reserve Bank had increased its gold reserves to levels not seen since the 1990s. This was public information, verifiable through official RBI disclosures. The central bank of a nation with 1.4 billion people was accumulating gold, while retail traders in that same nation were being liquidated from overleveraged futures positions. Turkey, despite facing significant economic challenges domestically, had been accumulating gold at a pace that surprised Western analysts. The Turkish central bank was not buying gold because technical indicators looked favorable. Turkey was buying gold because of currency instability, inflation concerns, and geopolitical positioning. Poland's central bank had publicly stated its intention to increase gold holdings to 20% of total reserves. This target would require purchasing hundreds of additional tons, a multi-year program that would not be derailed by a single day's price movement. These were not traders chasing momentum. These were institutions managing the monetary sovereignty of entire nations. And their buying patterns did not change because speculators panicked. This was the first layer of fundamentals that remained intact despite the crash. Central bank demand, strategic, persistent, operating on timelines measured in years and decades, not days and weeks. But there was a second layer, one specific to silver, one that had different drivers but potentially more immediate implications. For 5 consecutive years, the global silver market had operated in supply deficit, not barely, not marginally, significantly. Demand exceeded production. Year after year, documented by the Silver Institute through detailed analysis of mining output, recycling recovery and consumption across industrial, investment, and jewelry sectors. And the primary driver was not investment demand, which could vanish overnight if speculators lost interest. The primary driver was industrial demand, solar panels, electric vehicles, semiconductors, artificial intelligence infrastructure, data centers, 5G networks, medical equipment. Every technology defining the modern economy required silver. A single solar panel contains approximately 20 grams of silver. This is not negotiable. This is not dependent on market sentiment. Whether the price of silver is $120 per ounce or $84 per ounce, whether speculators are bullish or bearish, the solar panel requires 20 grams. An electric vehicle requires between 25 and 50 grams of silver, depending on the model and manufacturer. Traditional combustion engine vehicles require perhaps 15 grams. The shift to electric vehicles globally was not a prediction. It was already happening, mandated by government policy across major economies. Every automotive manufacturer had announced production targets. Tens of millions of electric vehicles per year by 2030, each one requiring double or triple the silver of traditional vehicles. This demand was structural, built into the technological transformation of the global economy, unaffected by whether retail traders in India or Pakistan or anywhere else were bullish or bearish on silver futures. HSBC had published a projection in late 2025. The silver supply deficit would widen further in 2026. Not narrow, widen. That forecast was made before the January crash. It remained valid after. Because the forecast was not based on speculation or momentum, it was based on counting. Counting mine production, counting industrial consumption, counting the gap between the two. And here was the critical factor that most investors never considered: mine development timelines. A new silver mine does not appear because prices are high. A new silver mine requires geological surveys that take years, environmental permits that take years, financing that takes years, construction of processing facilities that takes years. The lead time from discovery to commercial production typically ranges from 7 to 10 years. There were no major new silver mines scheduled to begin production in 2026 that would materially change the supply equation. The projects that would impact 2026 supply had been started in 2016 or 2017, when silver prices were much lower, when investment in new capacity was limited. So the investor watching markets on February the 1st, 2026, faced a decision that would define their financial outcome for the year ahead. Were these prices almost $40,000 for gold, or $922 for silver, a warning to exit? Or were they an opportunity that institutions were quietly evaluating while retail panic created temporary dislocations? The answer depended entirely on understanding one critical distinction: the difference between what had changed and what had not changed. What had changed was price, sentiment, leverage levels, technical indicators, market structure. These things were real. They mattered. They affected short-term outcomes. What had not changed was central bank strategy, industrial silver demand, supply deficits, mine development timelines, technological transformation requiring exponentially more metal, government commitments to carbon reduction and renewable energy. The fundamentals that drove institutional allocation remained intact. The question was whether individual investors could separate the two and position accordingly. In the aftermath of extreme market events, human beings divide into two distinct categories. The first category searches for certainty. They want someone to tell them what will happen next. They want a guarantee that the bottom is in. They want assurance that buying now will be profitable. They want answers that financial markets are structurally incapable of providing. The second category understands something more fundamental. Markets do not offer certainty. They offer probabilities. And the ability to navigate those probabilities, to manage risk rather than predict outcomes, separates wealth preservation from wealth destruction over time. For the serious investor watching gold and silver on February 1st, 2026, the path forward required abandoning the need for certainty and embracing a framework built on principles that have survived every market cycle in history. The first principle was simple but uncomfortable for those who had just watched prices collapse. Do not chase the bounce. When markets opened on Monday, February 2nd, movement was inevitable. Perhaps gold would rally at far as 5,000. Perhaps silver would jump as 15,000 per kilogram. And across every social media platform, voices would declare victory. I told you it was just a shakeout. We are heading to the moon. Load up before it is too late. History provided clear evidence of what happens after declarations like these. The first bounce after a major crash is almost always a trap. It lures back the traders who sold in panic, desperate to recover their losses quickly. It attracts new speculators who believe they are buying the absolute bottom. And then, in many cases, the second leg down begins. Professional traders understand this pattern intimately. They do not rush in on Monday morning. They wait. They watch volume to see if the bounce is supported by genuine institutional buying or simply short covering and retail speculation. They watch whether prices can hold gains or whether each rally attempt is met with renewed selling. This waiting is not passive. This is not indecision. This is strategic patience. The discipline to let the first move develop without participation. The wisdom to accept that missing the first 10% of a new trend is far preferable to catching the full weight of a continued decline. The second principle addressed a question that should have been asked before January 30th, but became critical after: position sizing. An investor who had allocated 10 to 15% of their portfolio to precious metals experienced a painful day on January 30th. Their portfolio declined. They felt the impact, but they survived. Their other holdings absorbed the shock. They remained financially intact and psychologically capable of making rational decisions. An investor who had allocated 50, 70, or 90% to leveraged precious metals positions experienced something entirely different. They experienced catastrophic loss. Positions were liquidated automatically. Capital was destroyed. And the psychological damage from such losses leads to worse decisions in the weeks that follow. Panic selling at actual bottoms. Revenge trading to recover losses quickly. Complete abandonment of any coherent strategy. Position sizing is not exciting. It does not generate viral content. It does not promise quick wealth. But it represents the mathematical difference between surviving market corrections and being eliminated by them. For precious metals specifically, institutional guidelines typically recommend allocations between 5 and 15% of a diversified portfolio. Some aggressive allocators push to 20% under specific macroeconomic conditions that justify higher exposure. But beyond 20%, the position ceases to be an allocation. It becomes a speculation, a bet, a gamble that one specific asset class will outperform dramatically enough to justify the concentration risk. And when that bet fails, when volatility strikes, when leverage multiplies losses, the consequences are not temporary setbacks. They are permanent capital destruction. The third principle required developing a skill that most investors never master: the ability to separate signal from noise in an information environment designed to exploit emotion rather than inform judgment. In the week following January 30th, hundreds of videos would be uploaded, hundreds of articles would be published, thousands of social media posts would circulate claiming to know what was coming next. The vast majority would be worthless. A framework for evaluating information quality required asking specific questions before accepting any analysis as credible. Does the source use emotional language designed to trigger immediate action rather than careful thought? Words like urgent, must act now, last chance. They don't want you to know this. Does the source construct enemies to explain market movements? Shadowy manipulators. Corrupt institutions, hidden forces working against retail investors. These narratives are emotionally satisfying but analytically empty. Does the source present only bullish information while ignoring bearish data? Or only bearish information while hiding bullish fundamentals? Every honest analysis contains both cases. Markets are complex systems with multiple forces operating simultaneously. An analysis that presents only one side is not analysis, it is marketing. The fourth principle was perhaps the most difficult to implement because it required accepting uncertainty as permanent. Wait for confirmation. Technical analysts monitoring precious metals would be watching specific levels in the days and weeks ahead. These levels were not arbitrary. They represented previous support and resistance zones where large volumes had traded, where institutional orders had been placed, where the balance between buyers and sellers had shifted historically. For gold, the Rs 1 torrent 45,000 level was critical. A reclaim and hold above this level would suggest that the correction might have found its floor, that buyers were willing to step in at current prices with enough conviction to absorb selling pressure. A failure to reclaim R1 torrent 45,000 and a subsequent break below R1 torrent 35,000 would indicate that further downside remained probable. For silver, the battleground was the RS2 pushing to 80,000 toward to a 300,000 range. This range had seen enormous trading volume in previous weeks. A weekly close above or 300,000 would be technically significant. It would suggest that the crash had been absorbed and a new uptrend might be establishing. A failure to reclaim this range and a break below RS2 70,000 would suggest the correction had further to run. But here was the critical point that separated professional risk managers from gamblers. No one knew which scenario would unfold, not the analysts at major investment banks with teams of researchers and sophisticated models, not the technical experts with decades of experience and thousands of trades executed, not the YouTube personalities with confident predictions and absolute certainty. The future was unknowable. What separated professionals from amateurs was not the ability to predict which scenario would occur. It was the willingness to wait for the market to reveal its direction before committing significant capital. This meant watching price action without participating. It meant allowing the first moves after the crash to develop without trying to front-run them. It meant accepting that missing the first 10% of a new move was strategically superior to catching the full decline of a continued collapse. Patience was not inaction. Patience was disciplined observation, the highest form of strategic positioning. And for Indian investors specifically, there was one additional factor that required careful evaluation. Union Budget 2026 had been presented. The details on import duties for gold and silver were now public information. Whatever the government had decided, whether duties were raised, lowered, or unchanged, the uncertainty was resolved. This resolution would affect short-term domestic price dynamics, but serious investors needed to separate short-term policy impact from long-term structural trends. Import duty changes affected the premium of Indian gold prices over international spot prices. They affected profit margins for jewelers. They influenced consumer demand at the margin, but they did not change the fundamental drivers of global gold prices. Central bank accumulation operated independent of Indian tax policy. Global monetary conditions were not determined by Finance Minister Sitharaman's budget decisions. Understanding this distinction was critical for making rational allocation decisions in the volatile environment of early February 2026. The framework was complete. 4 principles. Not predictions, not certainties. Principles that could be applied regardless of which direction markets moved next. Avoid the bounce. Size positions appropriately. Filter information rigorously. Wait for confirmation. These were not tactics for this specific moment in precious metals. These were foundations of capital preservation that applied to any market, any asset, any time period, any condition. Because markets change, assets change, economic conditions change, but human psychology remains constant. Fear and greed, panic and euphoria, the impulse to act and the discipline to wait. The investor who mastered these principles would not win every trade, would not call every top or bottom, would not achieve the mythical perfect entry and exit that exists only in hindsight and trading stories, but they would survive. They would preserve capital through corrections. They would be positioned to participate when fundamentals reasserted themselves. And over years and decades, survival compounds into something that speculation never achieves, lasting wealth.